Good morning, everyone. I'm Steve Hayes from Belair Communication in Amsterdam, and welcome to this media roundtable with AXA Investment Managers. The subject of the roundtable is Chinese economic and market lessons from the pandemic curve. We'll go first through the three speakers, and I'll introduce them in a second. Could you wait with questions, please, until the end of the presentations? And then, or during the roundtable, you can put your questions in the chat room, which you'll find at the bottom of your screen. So anytime you can put the questions in there, and then we'll deal with them in order after the presentations. First of all, we're going to move to geopolitics, and we're going to have a presentation from FRANS-PAUL van der Putten, who's the Senior Research Fellow at the Clingendael Institute and also coordinator for the China Clingendael Center. FRANS-PAUL, over to you, please.
Hello, everybody. I want to use the opportunity to say a few things about the geopolitical side of this. What I'm talking about specifically is the fact that China is in the lead of the recovery process. So China is already in a situation is ahead of other countries, and the question is, what does this mean? What is the geopolitical relevance of this? And I think what's going to happen now is that we're going to enter a new phase of intensified geopolitical instability. So the world already entered into a phase of greater geopolitical instability over the past 5 to 10 years. And I think what's happening now is a further increase in instability. And I have 3 points that I want to raise to further clarify this. The first point is I expect that China, the rise of China and the ambition of China towards greater international leadership is going to accelerate because of this. We can see some first signs now already since the past few weeks. I think since the end of February, the tone of China's foreign policy has become much more self-confident, much more outward and forward-looking. We can see this to some extent in the so-called face mask diplomacy. So the emphasis that the Chinese government puts on its role in providing aid to many other countries when it comes to medical protective supplies. And I think there will be more of this. And why? First of all, because of the need that the Chinese government feels to control the crisis, so both the health crisis and the economic crisis. China is not able to isolate itself from the rest of the world, and clearly the Chinese government is not going to try to isolate China. So the only alternative for China is to move forward, to be more involved in international affairs and to play a greater leadership role. And also this fits into the longer term ambition that I think the Chinese government has to play this more important role in international affairs, to gradually become more of an international leader, also to make sure that China's economic and security interests in the world are more secured. That was the first point. I will now move to the second point. That is that this increased ambition of China to be more involved internationally and to be more of an international leader creates further increases the tensions between the United States and China. Recently, we have seen this in the ongoing argument between the two governments about where the coronavirus originates from. So the U.S. government has been trying to make the point that the virus originated in China, and the Chinese government failed to respond actively, adequately in the early phase of the crisis, and therefore the size, the scope of the crisis internationally has become much bigger than it otherwise would have been. This has been a deliberate foreign policy push by the United States government to make this point. And of course, the Chinese government has responded very strongly and very negatively against this. I see this as part of a longer-term process in which the US government regards China as the most important long-term challenge to US national security, economic interest, and also to the, let's say, the US way of life. It's a major challenge. There has been this trade conflict between the two countries, spilling over into the technology cooperation area, and now I think it's also spilling over into the health sector. So the more that China moves forward, the greater the pushback from the US government. The third point I wanted to make is there's also an important relevance for in the digital domain. So China becoming more influential, more involved in international affairs, especially now in international health coordination and health affairs. There has an important digital aspect to it, digital domain aspect. For instance, in the area where the important role that mobile phone apps have been playing in the Chinese government effort to contain and control the corona crisis. This raises the question, I mean, also the opportunity for other countries to consider whether they want to follow the Chinese example. So also to make greater use of the personal use of citizens of their phone, and in order to control their movement and to have more control over the self-containment aspect of the crisis. Countries can follow the Chinese example. They can also perhaps make use of the Chinese technology that is now available. And this, of course, creates dilemmas, not just at the national level for the countries themselves, but also internationally. If China takes the position that whatever countries domestically do with regard to the crisis also has an important impact on the global situation. Therefore, there is an increased need for countries to define a common approach to how to use this kind of technology. So this creates dilemmas in terms of privacy, in terms of the standard setting internationally, and in terms of national security issues, because not all countries feel comfortable with using Chinese software for their domestic purposes. Then finally, I would like to conclude with some remarks with regard to the risks that result from this greater geopolitical tensions and greater geopolitical instability. I think one major risk is a lack of leadership in global governance affairs. In the G20, there was not a clear, the recent meeting of the G20 countries did not result in a very strong or very forceful form of cooperation and set of measures, I think. And it was even worse at the G7 meeting, where the G7 countries, although China was not part of that meeting, but there was, as I understand, a strong disagreement among the countries whether or not to refer to the coronavirus as a China-originated virus or not, something that the United States government was pushing for and that the other countries did not want to go along with. So even there was, I think, the spillover of China-US tensions, making it more difficult for countries to work together to contain the crisis. The second major risk is the further intensification of the economic pressure that the United States is trying to put on China. So the United States has been trying to the United States has initiated the trade conflict with China that 2 years ago, and the United States also initiated a push towards so-called decoupling, especially in the technology domain. So we could now also see this happen, for instance, in the medical equipment domain. A lot of countries are dependent on China for medical equipment, but China itself, for its medical equipment, for the more sophisticated equipment, is dependent on other countries for components. So if the US wants to decouple in this aspect from China, and China is then forced to further become autonomous in terms of the supply chain, this is, I think, also a further step in the longer-term process of economic disengagement between the US and China. And finally, to end with, I think that all of this further strengthens the risk that eventually there can be a military conflict between the United States and China. I think the United States has responded to the rise of China primarily with increasing the diplomatic pressure and economic pressure. The United States has a lot of tools that it can use, but there is a risk that if at some point the US government doesn't feel confident anymore that it can manage the rise of China with these diplomatic and economic tools, that it might start to think about using military tools. That is one aspect, and the other, of course, is that the more tensions there are, the greater the risk that there's an incident, a military incident between China and the US that was not intended by either of the two countries, but that could escalate into a major conflict. So I think in particular what is happening in the South China Sea and tensions surrounding relating to Taiwan are very important in this regard.
Thank you very much, FRANS-PAUL. Before we move on to AIDAN, could I just ask you a question before we move on to the Q&A? To what extent has this increased the use of surveillance technology in China, and what is the danger here with this extension of Big Brother to plot people with infections, this sort of thing?
The first response by in the Western media when China was implementing these tools was that this is not something that we would, in European or in Western societies, we would never tolerate this kind of very intrusive role of the government through these surveillance technologies. But now, of course, the crisis has become much more acute. So I think the mood is changing, has been changing in Western societies. So I think people are now more open and more receptive to the idea that these tools actually can be very important. Maybe not in the early phase where social distancing and self-isolation are the most important tools for the government, but maybe in the next phase where the governments in various countries will try to restart the economies. People will start to leave their homes more, and it will be more difficult for the authorities to control the mobility of people. So then these apps can be very beneficial. But then the question arises, which technologies are going to be used? And China already has developed them, and they are available. And I think the concern for Western countries is whether China might be able to use these tools to collect a lot of information about countries, maybe too much information, or that maybe other countries will become too dependent on Chinese technology, and that maybe in some later stage this could result in China being able to exert too much influence also maybe in the political sphere.
Thank you very much, FRANS-PAUL. Now we move to AIDAN Yao. AIDAN Yao is a senior economist China at AXA IM, and AIDAN is zooming in from Hong Kong. AIDAN, the screen is yours.
Good morning, everyone. So I cover EM Asia economy, and obviously China is a big sort of focus of my daily work. So I'll pick up on the discussion and try to pivot it somewhat towards the current situation in terms of the virus containment, as well as the impact on the Chinese economy and Beijing's policies going forward. So I'll focus on three things in my next 15 minutes or so. Firstly, what is the current situation on the virus front? How did we get here, and where are we heading to? Secondly, I'll spend a little bit more time to discuss the real economy. What has been the economic impact of this coronavirus shock? Where is the economy along the path of a recovery? And also what Beijing is doing in terms of helping the economy to weather the storm. And finally, I will finish off by discussing a little bit about the Chinese market. Why it has been so resilient compared to other markets, and what foreign investors are currently doing in this market. So let me first discuss the virus situation. Obviously, as we all know, China was the first country discovered the coronavirus in late last year, followed by its formal report to the WHO on the 31st of December. Then we saw heightened restrictions followed in Wuhan, which is the epicenter of the crisis. And then those restrictions spill over to other cities within the Hubei province. Then on the 23rd of January, Beijing decided to completely lock down Hubei province and raise the public response emergency levels to its highest. About 2 weeks after that measures, nationwide, we saw that the growth of the daily infection rates started to level off in early February nationwide. And as fewer and fewer cases were reported outside of Hubei, we saw those emergency responses that restrictions that other provinces put in place started to get removed fairly gradually since late February. And about 2 to 3 weeks ago, so sort of in the late February, mid to late to February, we saw that Hubei started to relax its restrictions, and also Wuhan started to follow suit since late last week. So all of these are obviously taking place as China has reported very low, effectively 0 cases within the country internally, which emboldens the government to pare back some of those heavy controls and let the society and the economy start to resume some normality in a fairly orderly fashion. So this is the current situation. And the question is, where are we heading to? Are we completely out of the woods yet? I think even though that China has made quite a lot of progress in containing this virus, there are still 2 risks that we have to constantly monitor and keep in mind. The first one is relating to imported infections, which have averaged around 50 cases per day over the past 2 weeks or so. So clearly, as the epidemic, the pandemics continue to spread globally, China cannot lower its guard on the imported infections. And that's why Beijing just last week started to impose temporary restrictions on the entrance of all foreign nationals and drastically cut the international flight between China and the outside world. So clearly, this is a precautionary measure that aimed to cut off those contagions between China and the rest of the world, which is still struggling with the spread of the virus. That's the first risk. The second risk is more domestic, and that involves the so-called asymptomatic patient. Those are the patients that do carry the virus but don't really present any obvious symptoms. Now, there's been quite a bit of a talk about these cases being of a large number in China lately. We had the CDC came out saying that the number is currently around 1,500 under the active monitoring and inspection of the Chinese government. And experts seems to have different views. Some say less, some say more, in terms of how big this really is a spread that represents for the country and the economy. I'm not an epidemiologist, so the only thing I can say is that this is a risk that we need to keep in mind and monitor fairly actively. But overall, I think the bottom line on this whole virus discussion is that there's no denial that China is more advanced in curbing this outbreak than many other developed economies and developed countries. So let me then move on to the second part, which we sort of focus on the real economy. Now, clearly, the Chinese economy has suffered quite a severe shock from this coronavirus outbreak. This is both a result of the virus itself that reduce the extent of a human mobility and their normal economic and social engagement. It is also a function of the draconian measures that Beijing has imposed to contain this virus that has led to widespread production suspension between late January and early March. So to reflect these shocks, we saw the economic data for January and February, such as the PMIs, the industrial production, the retail sales, all fell to their lowest levels on record. Now, the good news is that we know the economy has hit the rock bottom and started to normalize in recent weeks as the virus situation was brought under control. So we should expect a March number to show some quite substantial improvement, which we already saw with the PMI data early this week. The bad news is that this recovery is not as speedy and vigorous as one would like. And that reflects both the difficult internal balance between resuming the economy on the one hand and managing the risk of a second wave infection on the other. It also reflects the global economy has deteriorated quite markedly over the last month or so, and that will obviously undermine China's own economic rebound as well. So how do we break away from all these negative influences? Well, we think that the economy definitely needs some extra help from the Chinese authorities. Now, even though that we have seen China moving quite early and quite fast with the stimulus at the initial stage of fighting this virus, but it's interesting to see that the momentum of a policy easing has petered out over the months of March. So much so that its current support looks quite timid compared to the unprecedented responses that you get from the US and certain parts of Europe. Now, we think there are a few reasons for Beijing's more cautious behavior, but I won't elaborate too much here in the interest of time. But here I'll say is that we have always thought it's only a matter of time before the authorities act more decisively and more forcefully to put a floor under the economy. And that's indeed what we saw in the recent days with announcements from various of the Chinese authorities rolling out more substantive monetary and fiscal measures to support worker resumption and lift the growth momentum. I would expect more announcements and implementation of these policies in the coming days and weeks, although I would not see China engaging in full-blown unlimited QE as you saw in the US and parts of Europe. Taking all of these into consideration for our growth forecast, so we are looking at economy contracting by 7.5% year-on-year in the first quarter, which needless to say is the worst in modern history in number of decades. That would follow by a 0% growth in the second quarter, but more obvious growth rebound in the second half of the year as the global economy come back to life. And that overall quarterly projection gives us a full year forecast of 2.3% for 2020, which is a marked drawdown from last year's growth number of 6.1% growth. So let me finally just say a few words about the financial market. Year to date, we have seen Chinese equities down between 1.5% to 9%, depending on which market you look at. Shenzhen was down 1.5%, Shanghai was down 9%. That's compared to US and Europe are down between 20 to 30%. Credit spreads have widened, but certainly not near to the same extent as you saw in other emerging markets. And the RMB exchange rate actually appreciated on a trade-weighted basis by about 3% year to date. Now, I'm sure that some people are scratching their head with these performance numbers coming from the epicenter of this crisis. I was too surprised about these performance as well, but I don't think they are unexplainable. And I'm going to try to raise a couple of explanations. Firstly, we know that China leads the world in fighting this virus. And as we have discussed, the progress is already evident. Many countries are actually moving towards China's approach in fighting this epidemic. We also know that China leads the world in post-crisis recovery as well, which too has made quite a significant progress. On both of these fronts, China offers more clarity and visibility in the current situation and into the future than what is currently the case in the US and Europe. And we know that financial markets are like a certainty, they dislike uncertainty. So I think that situation, relative situation, bodes well for RMB assets. Secondly, we know that the parts of the Chinese economy that are worst hit by the epidemic are the SMEs, the small, medium-sized enterprises. But we also know that these companies do not really feature that much in capital market. They are not listed companies. They don't use the bond market for financing for working capital. The big corporates that are listed and on the exchange and accessing the bond market tend to be the companies that are less impacted by the coronavirus shock and have more benefit the most from the policy easing and the falling interest rate. So you would argue that there is a greater detachment in China between the composition of the market and the composition of the economy. And the third final thing is that investors seem to have a lot of faith in Beijing's ability to both save the country from the virus and save the economy from this gigantic economic shock. We know that Beijing has done well on the former in terms of fighting the virus, and the market is willing to give the authorities the benefit of doubt for saving the economy as well. Now, this is not just the belief of the local investors, but we know that the foreign investors are also continuing to invest in China in both equities and fixed income. We have official data show that there was 127 billion RMB net inflow into the China bond market in the month of February, despite the coronavirus outbreak. And we think that these inflows is going to continue due to index inclusion and a very attractive interest rate differential. Currently, China 10-year bond is trading at 2.6% versus the US equivalent at 0.6%. And I think the equity market story is very much the same. You got index inclusion, you got a resiliency of the economy and the earnings, and also stability in the currency that are auguring well for the RMB assets. So a combination of China leading the way in fighting the virus and the investors' confidence in China's ability to weather the storm has enabled the Chinese markets to outperform others. So on that note, maybe it's a good place to pass the screen to Mark to discuss more about our equity market views for China and Asia.
Okay, thank you very much indeed, Aidan. Just before we move on to Mark, how do those inflows in February into Chinese bonds compare with the same time last year? You said 120 billion renminbi. Was it roughly the same last year, or is it up or down, or what?
So January, the February number is a combined January and March. So we have about 130 billion, 127 billion. Now, if you look at the official numbers over the past 2 years, since the Citigroup included China into their global bond universe, we have seen just over 1 trillion RMB worth of capital inflows over a 2-year period. So if you divide that by 24 months, you roughly get about 50 billion per month. And so 127 billion is for January and February combined. So I would say this is a slight acceleration, but not too much more compared to the pace of inflows we have seen in the last 2 years. And that, I think, in itself is quite telling. It's suggesting that the foreign investors are not being scared off by what's really happening on the virus front and on the economic front. And if I need to put a sort of a finger on the forecast for the future months, I would say this is going to continue. And we also know that in February, JP Morgan brought the Chinese market into its global EM index as well. So that's going to give you an additional boost for foreign inflows in the coming months.
Thank you very much, Aidan. Now we're going to move on to Mark Hargreaves, who's the head of FRAMLINGTON Global Equities. And he's going to talk about the impact on the Chinese equity markets. Mark, over to you, please.
Good morning, everybody. Thank you very much. So what I want to do is just build on some of the points that Aidan was making, and then put it a little bit in a kind of dedicated equity market perspective. And really a couple of areas is to see where we are now. Maybe give some feedback on the ground from meetings and companies we've been interacting with. Talk a little bit about how the different areas of the markets have reacted to the crisis, and are there any insights and read across potentially we can take from that to other markets here in Europe, and then a little bit on the outlook side. How should we think about things as Aidan says, is trying to move on to the next stage out of the crisis. We do have some slides with this presentation, I think, that are available afterwards. So I'll be referring to various numbers and companies, and you will be able to see the slides afterwards with the detail on that, just to refer to that. But if we start off, as Aidan said, that the Chinese market's been very resilient, equity market has been very resilient this year, down considerably less than all other major equity markets. And we've touched on a number of reasons there, but I just want to spend a little bit more time on that. So firstly, as Aidan alluded to, there is China was first into this crisis and therefore is expected to be first out. And actually there is some visibility on how it comes out of the crisis. And the question is, can we take that as a read across? And I think elements of it we can, and elements of it we cannot. I think one of the reasons why the Chinese market has been so resilient reflects some particular features of the Chinese market. So yes, it was first in. China government has an active response mechanism for reflating the economy. It's done that in the past, and therefore there's confidence in that. Retail investors have been investing in the market. They've been stuck at home with not much to do, and they have the confidence that the government will do whatever it takes to get the economy going again. So I think that supported domestic flows into equity markets, which have been very resilient. But there's another feature of the Chinese market that it really is a two-tier market. You have what are called the state-owned enterprises as one part of the market, and then you have private companies in other part of the market. And the state-owned enterprises are effectively government-backed. And their debt is effectively government-backed. Many of these are quite leveraged companies. And if they were in a different market environment, a highly leveraged company in, say, Europe at the moment, or in the US, is really getting impacted very, very hard because of liquidity concerns for some of these companies. In China, it's different. These companies don't have that same risk because they're effectively backed by the government. So that's, I think, been quite a major support for why the Chinese equity market is held up better than other markets that we've seen across advanced economies. And that's obviously not a read across we can necessarily take for other countries. But what we have seen, obviously, is very rapid actions both from in Europe and the US, both from governments and from central banks to provide major liquidity support for businesses. So in that sense, we are seeing short-term a little bit of move to more a Chinese model in that sense of major kind of public support for the corporate sector, trying to provide some stability. So what are we seeing on the ground at the moment? So as Aidan said, is that things started slowing down at the beginning of the year, and really then in February we got this major lockdown. But actually, since March, we've started to see an improvement. On the slides that you'll see afterwards, I've included a few quotes, and actually they're from overseas companies. I think just to give a very clear independent reflection of what's going on. But you know, we have in FedEx, one of the vice presidents saying, you know, we've seen a rebound every week since the beginning of March. We've seen the Dow CEO saying, you know, our demand is good right now. In fact, the last 2 weeks, we've seen our demand in China bounce back. So the industrial side of the economy is bouncing back. We can see that in data for power consumption and other measures that you would traditionally use. So still below levels, but it is bouncing back. And it looks like now about 90% of industrial production in China is effectively back up and running one way or another. The area that is going slower, and I think this is a read across that we can take for other markets as we come out of this over the coming months, is that the consumer side is recovering more slowly. Production is quite easy to ramp up, but the consumer has clearly been quite majorly impacted. On one side, people want to get out. They've been contained, I'm sure, as we're all aware, as we're under more isolated measures currently. People want to get out, but people are cautious as well. And as Aidan has alluded to, there are some restrictions already on the ability of how you can move around. There's very close monitoring by QR codes. Every Chinese individual has a QR code currently for use for their smartphone, as part of monitoring to kind of monitor and allow certain people out. But if you're in a higher risk area, you're still not allowed out. So the lesson will be that the industrial side of the economy is picking up quickest. The consumer side will be slower. And I think we'll see similar trends in Europe and the US when we get more into that recovery phase. But there are signs that things are happening. John Donohue, who's the CEO of Nike, was talking last week. And I think his statements were pretty encouraging and quite surprising to many. He basically says containment took 5 to 6 weeks, stores were closed. E-commerce actually remained quite strong, and I'll come on to e-commerce in a moment. But actually now we're calling recovery, is his words. Retail is starting to open back up. Consumers are back on the streets, and we're seeing a gradual move into normalization. So even that consumer side is picking up, and I think that will increase over the coming weeks. So I think that's an insight of what we would expect both in Europe and the US over the coming months. So if we think to the market, you know, how is it responded about this? You know, firstly, overall, it's been very resilient, and I've touched on a couple of, I think, unique features to China for that. But there has been divergent performance within that. And I think one of the interesting things is, are there any kind of read across we can take from the China experience to other markets? And are there any longer term implications? And I think the main ones, there's a couple of areas I'd like to focus on, is firstly, you know, the COVID virus has accelerated some trends that were already well in place. And in particular, I talk about the move to a more digital-based economy, a more online-based economy. Those trends have been with us for many years. It's an investment theme that we've been following very closely. We view this as a very long-term structural theme as we transition the economy online from an offline physical store world. But the COVID virus has accelerated that because, firstly, under the lockdown conditions, you've seen people having to go more online. But what that's also done is introduce a new cohort of customers to the online world that weren't using it before. So we don't think this is a short-term phenomenon. There was a structural trend in place, but actually now what we call the TAM, the total addressable market, has expanded as a result of a whole new customer base using these services, and they will continue. So if you look at the performance of companies in China, companies such as Tencent, which is more on the gaming side, video gaming has done well. Alibaba, which is the Amazon and eBay of China, has performed pretty well. Actually, Another area which I'll come on to sec is on healthcare. But so those areas have performed well. Unsurprisingly, not everything in digital has done well. So Trip, which does travel, hasn't done well. So there clearly is differentiation within that. But that shift online has continued. Linked to that is on the healthcare side. China is trying to make great strides to improve its healthcare services. They're still quite basic, rudimentary. There's a massive shortage of hospital places. This is one of the real challenges with dealing with the virus, that the healthcare system was coming under a lot of stress. So we obviously saw temporary installations being built in Wuhan, for example, but also there's been a big shift because there's a shortage also of doctors. A big shift to online as well. So businesses such as Ping An Healthcare, which does telemedicine, being a strong performer and very much a kind of structural trend, benefiting, trying to provide support in a more remote environment. And I think this is a feature that we will see both in China, but more generally as we think about medicine and medical delivery, that we're going to try to accelerate this move towards more telemedicine and integrating that into medical services. Teladoc, which offers similar services in the US, has been a very, very strong performer, both into the crisis and during the crisis. And I think, shows some interesting implications of where we go from healthcare delivery to a combination of physical hospital-based solutions, but a more remote-based solutions going forward. Other businesses have had to adapt. Education is very important in China. Parents want their children to do well. There's a lot of emphasis on education and then a lot of additional support services. So after school tutoring is very, very strong. So businesses such as TAL Education and New Oriental, which provide these services, obviously they were impacted by the fact that you couldn't bring classes together. But again, they've moved more to an online model. And again, so you've seen businesses reacting quite fast from a physical world to an online world. And I think these trends again will accelerate. So online education is another area that is benefited well through this process. Clearly not everything has been immune though to the challenge. Clearly in the short term, industrial production was hit hard. The construction market was hit hard, the travel and leisure industry. So we have seen businesses being impacted negatively during the period. If we think about how China will come out of this, the way we think about this is in a twofold process. We think of the short term, probably initial recovery, and then really more the medium longer term, where is the Chinese economy going over a multi-year perspective. So in the short term, we expect actually probably some of the areas that have been a little bit weaker, such as the property stocks, the construction stocks, some of the commodity orientated businesses, will probably see some support and recovery in their share prices over the next 3 to 6 months. And that is because the government will take a very active role in trying to re-stimulate the economy. And historically, how they've typically done that is basically through fixed asset investment. And they do that through the property market, and they do that through infrastructure investment. So that means more cement, more steel, more construction equipment. So those type of companies we feel will benefit in the short term, and the performance will probably be relatively good from those stocks. These industries have fundamentally structural long-term oversupply, and they face kind of quite a challenged medium-term profile from a profitability perspective, because China has already invested a huge amount in its fixed asset infrastructure. So there will be a short-term stimulus, but what there won't be is a multi-year stimulus, I don't think, of year-on-year investment because of the existing investment that's already been put in place. So on a medium-term view, we're more cautious on the outlook of many of these companies, but they will benefit, I think, from that initial recovery. So what do we think about more medium-term? The reality is for us, China is transitioning, and it's transitioning in several ways. So firstly, it's moving from an economy that it was more about fixed asset investments to a more consumption-based economy. That has been happening, and that trend will continue over the next 5 to 10 years. And therefore, really, from an investor's perspective, you want to be positioned more towards consumer-orientated businesses than maybe some of the traditional heavy fixed asset industries that benefited over the last 20 years, but face more challenges, particularly given the levels of oversupply. The other area is China is looking to go into higher value manufacturing. The days of China being the cheap workshop of the world have actually ended. It is more expensive to manufacture on the coastal China region than it is in many other parts of Asia, and even in countries such as Mexico. So we are actually going to see, I think, over the next 10 to 15 years, a gradual evolution of global supply chains. And these are driven by economic factors, but what will also contribute to that is what we've seen over the last 5 years is there are additional reasons why companies might need to rethink their supply chains. The first one actually relates to the trade conflict. We've clearly seen there is a risk that businesses can see overnight restrictions put on their ability to move goods around the world linked to a trade conflict, and therefore they need to have a more diversified sourcing mechanism rather than being reliant on one particular geography such as China. The second area is that actually we've now had a series of natural incidents which have highlighted the fragility of very extended global supply chains. We had the Japanese earthquake back in 2012 as one. We had the Thai floods a few years ago as another reminder, which impacted certain areas of the technology sector. And obviously now we've got the coronavirus. So I think, you know, as a result, we are going to see some changes within that. But going back to the original point is for China, being that cheap labor pool of the world, they need to change their model and move up the value chain. They are doing this. They're investing in areas such as technology. They're investing in areas such as renewable energy and electric vehicles. China hasn't been successful in traditional vehicles, but it views this as an opportunity as we transition to an electric vehicle world that they can actually now maybe take a lead in elements of this, particularly on the battery side of production. So companies such as BYD, which are involved or have been performing well and I think are well positioned. And then I think the final area which will benefit is, as Aidan alluded to, and Franz talked about healthcare. I think we are going to see more investment in healthcare. China will look to expand its coverage of its healthcare system. And it will continue to invest in this area. This will remain opportunities for them, but China will want to encourage some domestic opportunities there. We have companies such as Xingzhou, medical equipment in the portfolios that we manage in our China portfolios. They do ventilators, obviously benefit will and start to try and lead from an innovation perspective. So that really I wanted to kind of wrap up the main points. So as I said, is the market has been resilient. We see the factors behind that. We understand them. We think they can be explained and they're rational. That initial recovery probably will be led by the more fixed asset side of the economy, but actually longer term, and I think from an investor's perspective, it really is more where China is going on a 5 to 10 year view that's probably more interesting. And that's from an investment point of view where our focus remains. We have added a few construction names recently to do position for that initial kind of recovery, but the fundamental basis of our portfolio is geared to those longer term changes that we see for the Chinese economy. With that, I'll stop and we can open for any questions.
Nobody's really mentioned the impact of the export economy falling away. Presumably with the rest of the world in lockdown, how's that going to impact the economy? To what extent is the Chinese economy dependent on exports now, and how much is the consumer economy growing, and will that accelerate that trend? And are there any companies that are going to suffer from that because there's probably no winners there, particularly more than others that stand out? Mark, perhaps you could take that one first.
Sure. So I think, yeah, I mean, I think this is one of the questions. So while we're seeing a recovery in China short term and industrial production picking up, the question is, where is that going to go? Because there is a demand shock now. This was originally a supply shock as production was closed down. But we've now seen obviously a demand shock, and that demand shock is now global. So, you know, there are some questions there. I think China is much less dependent on export-led trade than it was 10 years ago. So the current account surplus in China is largely gone. I think it's maybe 1% this year, whereas back 10, 12 years ago, and AIDAN can give them more details, but it was nearer the 8 to 10%. So actually, the trade conflict kind of discussion actually is more relevant to where we were 10 years ago, not to today. China is no longer, I think that dumping stuff on the world market in the same way, running massive current account surplus with a cheap currency. That's ended. The current account surplus is effectively gone. So today's dispute is much more about a technology conflict, and I think, and a geopolitical conflict, while it's discussed as a trade conflict. But so the reality is it's less dependent on export side, but there will still clearly be an impact, and certain industries will be impacted. Some of the industrial side of the economy will be impacted. Technology side, again, China is used for a lot for assembly type businesses. So in the areas that are probably more vulnerable are in textiles and clothing and consumer facing goods, which are also being impacted short term by closure of shops in Europe and the US. Other areas such as smartphone related activities is some impact, but I think lower. People can still order things online, but again, there's been a slowdown there. So yeah, they're not going to be immune from that overall. And that's why I think the recovery will probably continue to be quite muted. That's why the fixed asset investment will likely be ramped up by the government. If overseas demand remains weaker for longer, as we all in Europe and US work through our isolation periods, I think the government at the moment, and as AIDAN has alluded to, are monitoring things, and they will just increase fixed asset investment and domestic investment to help offset that export weakness. If we have quicker resolution of isolation and both in Europe and the US, we get back to things more quickly, then they will have more export demand to rely on, and we need to do less investment.
Thank you, Mark. We have a few questions coming through now in the chat box, and the first one is from Ronald Koch at Annalise Puntanel. And Ronald's asking, what would you consider as a very low risk defensive portfolio in this situation? So
I'll talk from an equity perspective, and then maybe AIDAN can give some perspectives on a broader. So I mean, clearly equities are the more risky area of the market. So simplistically, low risk would be bonds. That would, and you can see that there's a yield enhancement you can get from overseas investors. So I think from the bond side, the first one is simplistically bonds are lower risk. If you're thinking from an equity perspective, what this crisis has shown is it's turned a few traditional assumptions on its head. And this relates both to China, but actually there is a read across here to other markets, and we've seen it in Europe and the US. So, you know, traditionally when you think about defensive, you think about businesses which have very secure demand, very reliable demand, and not much variability in that demand. And, you know, consumer staples, food producers have fitted into that bucket. Elements of healthcare have, but areas such as telecoms and utilities have traditionally fallen into that. And actually what we've seen is some of these have been turned a little bit on their heads. So power demand is down very sharply. It was in China, it's recovering now, but in Europe it's going to be down around 15%. And the US it's still holding up a little bit better, but if they have more shutdowns, it will be a leader. So of what's to come. So utilities, which are traditionally defensive, are not at the moment. Within healthcare, excuse me, actually parts of healthcare are defensive, particularly on pharmaceuticals, drug production. People are still taking their daily drugs, they can order them online. But what has impacted is more medical equipment. So as hospitals have had to deal with coronaviruses, they've stopped doing elective surgeries in other areas. So actually quite a number of medical equipment businesses, so if you think about knee surgery, hip surgery, a lot of those are being postponed at the moment. So only really critical care things are happening. So actually even within that, areas which were traditionally defensive are less so. We view those as an opportunity because that demand will come back, and actually these are good businesses longer term. Consumer staples have held up quite well. But the other way to think about it is also, and the way we think about it is actually, you know, the most resilient areas in this have been really those businesses that are kind of providing support to the process. And that goes back to this shift to online. So companies such as Alibaba, Tencent, they've been quite resilient through this process, but actually we would view those type of businesses really as good long-term holdings, really because one, they've been very resilient through the process, but also, going back to what I said, is their competitive position has got even stronger through this side. So, you know, Alibaba is retail; it should be awful, but it's not. And therefore, I think when we think about defensive positioning, we're thinking about it in really a different way to you traditionally do. So we would think about it through that online side, and then actually we think there are some really interesting opportunities where some businesses have had, on like the medtech side, have had some speed bumps, but good long-term opportunities. Within China, many of those businesses have held up, so the valuation opportunity isn't there. Actually, we're seeing some of those opportunities in that case, in the medtech side, more in Europe and the US, because the businesses have been impacted short-term and will come back, whereas many of the businesses in China have been supported by people willing to look through for the longer-term picture.
Thank you, Mark. Aidan, do you want to jump in there on the fixed income side for a defensive portfolio?
Yeah, so I guess that if you look at the fixed income, you essentially exposed to two types of risk. One is interest rate risk and one is credit risk. On the interest rate front, I guess it's very much a consensus that the central banks is going to continue to pump liquidity into the system. Interests are going to remain low. So in this environment, you want to long duration, right? You want to extend your exposure to that falling interest rate. On the credit side, it's also quite easy to think that when you are talking about economic downturn, you generally try to move away from those low credit worthy high yield names towards a more solid names with a strong balance sheet, and in China's case with government backstops, i.e. the SOEs, sectors that are relating to the government's stimulus should perform well. And that's indeed what we have done with our fixed income portfolios, migrating from those short duration to longer duration, and also from the lower credit worthy risk spectrum towards the up range to increase the credit profile of the portfolio. Okay,
thank you very much, Aidan. Dorinda, you have a question about the export partners, but I think we covered that with Mark's last response. If you don't agree, then please put another question in the chat box. We're going to move to Chiba now from Pension Pro. And Chiba, I'm going to move on to your second question, I think, which is a bit more meaty. Will the coronavirus have a structural impact on the Chinese economy at all, or merely accelerate ongoing trends? I suppose it will accelerate the shift of global supply chains. And can you elaborate a bit more on this? I know Mark touched on the supply chain aspect and probably the sales to inventory ratios, but can you fill us in, please, Aidan?
Yeah, so on the supply chain front, so I'll say that there are three types of companies, multinational companies investing in China. The first type that got into China for the cheap labor, cheap resources, cheap land, government policies. So over the past couple of decades, so they are really there for the cost of production. The second group of countries that operate in China are essentially for the complete comprehensiveness of China's supply chain. You know, China is the only country in the world that has all 64 type of industry categories categorized by the UN, and there's no other countries in the world achieve that. So basically, you can produce most of the products that consumer buy with the entire supply chain all in China. So that's the second type of company, and you manufacturing these not necessarily just for final consumption in China, but you can ship it all around the globe. The third type of company in China are more for the Chinese market. And you would argue that the likes of McDonald's, the Starbucks, KFC are those type of companies. So if you think about these three type of companies and think about how the coronavirus is going to impact them, I think the part of the corporate sector that has already moved out of China are the ones that went into China for the cheap labor. And as Mark talked about, that China's cost competitiveness has already been diluted over the last couple of years, given the rising cost, the rising environmental expenses, and rising labor, and also the currency appreciation. So I think in that regard, the coronavirus may actually accelerate that trend, because it adds more incentives and catalysts for these people to move out of China. The third group that are in China for the Chinese market are not going to move, because I don't believe that this coronavirus is going to fundamentally change the structure of the Chinese economy. Mark mentioned that the whole economic rebalancing from investment from industrial sector to consumer sector is going to remain intact. And these companies that going there for the 1.4 billion people market are going to remain in China. I think the key risk is the second group of corporates that are in there for the supply chain. And I think Mark mentioned a number of very good reasons why these companies may think twice, given the US and China trade war, given the coronavirus shock exposing the vulnerability of the stretched supply chain. I would imagine that it will make some companies think twice and start to at least diversify parts of their production. But as I mentioned, China, it's being called a world factory for a good reason, for a fundamental reason, because it's the most comprehensive in offering those different industrial goods along the supply chain. So I think, well, some of these companies may moving out, but I don't think the pace will be very fast.
Okay, thank you, Aidan. Now we'll move on to Jeff Tyson from Valuespectrum Belangen. And Jeff's question is, I think to Mark probably, what are the risks involved in investing in a couple of the companies you've mentioned? Because a lot of these companies have a variable interest entity structure, sorry. These are contractual agreements instead of direct ownership.
There are a number of different factors you have to consider when investing in the Chinese market, equity market. So you've obviously, firstly, you've got the A shares, the H shares, and the ADRs. So you have a different number of options, and there are different challenges with different types of holding. So the A share market can be pretty volatile. I think we've had quite a few corporate governance issues, and corporate governance and transparency is a challenge. Not everywhere, but with some businesses. So, China is a market where you need to really have on the ground insights and experience. And obviously AIDAN's based out in Hong Kong, and we have others out there to really, and we have an entity in Shanghai from a research perspective as well that we partner with, because you really need to be on the ground to be aware of some of the challenges. And you have to set, I think, quite a high bar in terms of quality. For some of the other companies like Alibaba and Tencent, yeah, they do have the structure in place. Yeah, at the end of the day, all companies have different risks and different challenges, and I think the structures you have for those types of as a shareholder of that business is you incorporate that in your analysis of the business and in the cost of capital that you apply. And I think, as investors, we do that. The reality is if you want, China is a market of 1.3 billion individuals. Alibaba has 70% market share in online retail in China. Arguably one of the biggest, if not the biggest, retail market in the world. 10% dominates in the areas it operates in. In terms of the shift to areas like digital payments, Alipay and WeChat dominate on those payment side there as well. So the reality is, if you want to get exposure to these very strong trends, these are the only businesses that can provide you that exposure. And then you have to balance that against the corporate structures that they have. Now, I would say that now that these businesses are of such a size and such a geopolitical significance that actually gives you an element of security as an investor. They're held by a very wide range of investors globally, both onshore China as well as overseas, and then therefore it is in no one's interests to ultimately done a listing in Hong Kong, and again just showing diversifying in terms of its base. But I think is it a structure that we have in other countries? Not necessarily. Do we incorporate into our consideration our cost of capital, our analysis? Absolutely. Do we own them? Yes, because we feel on balance these are businesses that you should hold for the longer term.
But, thank you everybody for your attendance and zooming in, and I hope you enjoyed the virtual lunch that some of you received. Okay, thank you everybody, and goodbye.